Earlier on in this mini-series we saw a quick example of how portfolio diversification can be really powerful in assisting you with reducing the overall portfolio risk. This time we start to get into specific techniques you can use, and we'll be covering the first of these, diversifying across asset classes. Once again, I'll be backing this up with an example so we can start to get an idea of the scope for improvement in that risk reduction using this technique. Stay tuned. So far in this mini-series we've looked at 3 episodes that have covered these subjects. Today we start to look at the specifics of how diversification can be put into practice. The first of these techniques, which is using diversification across asset classes. And this will be the first of 4 episodes, each of which will be looking at a different technique. Now, before getting into any detail, let's remind ourselves about the concept of diversification in a portfolio. So we defined diversification as a technique that contributes towards lowering the overall portfolio risk. But we also looked at how the underlying assets that are being traded as part of that portfolio need to be uncorrelated in order for this technique to be effective. And because in normal circumstances different asset classes tend to be relatively uncorrelated, this makes this an ideal technique. Now, by asset class, I'm talking about, for example, Forex, or stock indices or commodities. And of course, within these, we can also subcategorize. So for example, within commodities, we might have energy-based commodities like oil and gas, precious metals such as gold and silver, and various different food commodities. And so by taking the approach of trading multiple of these in the same portfolio should reduce the overall portfolio risk. And of course, if we can do that, it means that we will be increasing the reward to risk ratio of the portfolio. So let me explain the example that I'm going to be using today. This will consist of just one Forex currency pair and one commodity. And specifically, this is going to be the pound versus the New Zealand dollar and gold. So let's get straight into it and take a look at the results. So here I've got the results from 2 back tests, one from gold and one from the pound versus New Zealand dollar. And just to remind you of the format of these charts, the blue line you see in the middle is the equity curve. The orange line at the top is the high watermark, so every time the equity makes a new high, that watermark rises. And the grey line at the bottom represents the risk tolerance of the trader, and this will be different for every trader. So I have this set at 10%, which means that if the equity were in a 10% drawdown, then it would be touching that grey line. If it went beyond 10%, then of course it would go below it. And we can see here that both back tests produce a profit, but they also suffer fairly big drawdowns, and both of these reach halfway to the tolerance level. But what you'll notice is that because these assets in the 2 asset classes are relatively uncorrelated, it means that the drawdowns occur at different times. And what this means is that when gold is performing well, pound New Zealand dollar might be suffering a drawdown, and vice versa. When pound New Zealand dollar is doing well, it might mean that gold is in a drawdown. And the idea of diversification across uncorrelated asset classes like this is that those drawdowns get smoothed out. Now let's scroll across and take a look at what happens when both of these assets are traded simultaneously in the same account, and so therefore producing a single equity curve. And hopefully what you will notice is that the equity curve appears to be smoother, the drawdown percentages appear to be smaller, and so overall this is preferable than trading each one individually in their own account. But of course, looking at the equity curves is one thing, seeing specific metrics is another. So let's take a look at what those metrics are. So here we're looking at three metrics. One is the compound annual growth rate. We're looking at the maximum drawdown experienced during the test. And then a single metric, which is the CAGR over the maximum drawdown, to give us that single quantifiable and comparable measure. So first of all, in terms of the maximum drawdown, you can see that gold has 5.4 and the pound New Zealand dollar 5.1%. However, when we combine these into a mini portfolio, that drawdown reduces to just 3.2%. Now, when we combine that with the CAGR, there's a fairly dramatic difference. So we have 0.6 for gold, 0.4 for pound New Zealand dollar, and 0.9 for the mini portfolio. So hopefully now the benefit of trading a portfolio that includes multiple asset classes is becoming clear. And of course, you're not restricted to just two asset classes. We could also combine stock indices into this particular model. And then hopefully we would see further improvements in that risk management. And what we can also do is to look at the individual equity curves side by side, as you can see here. So the blue equity curve is trading gold on its own. The orange equity curve is trading pound Kiwi on its own. And the grey line in the middle is the mini portfolio of both in the same account. So I thought it would be a good idea now to look at diversification in action. And to do that, what better way than to look at some of the systems on the Darwinex platform. The top section here shows those traders that have got the most investors. So this is where investors can back those individual traders, and then the traders can earn a success fee as each asset gains in value. So I'm just going to take a quick look at this JHU Darwin. So here you can see this has had pretty successful results over the last 5 years, making probably an average of about 20 to 30% each year. And because of that, this Darwin has managed to attract 254 investors. Now on the Darwinex platform, this is extremely feature-rich and provides many metrics which are designed at helping investors decide who to invest in, but also provide really great information to the traders themselves to help them improve their own systems. Now one of these is the Assets and Timeframes tab. And the area with particular relevance to this episode is the asset allocation area just here. Now, by hovering over each of these segments, you can get an idea of which assets this trader is trading in this account. So here, for example, we can see the WS30, which is the Dow Jones Industrial Average. Here, the J225, which of course is the Japanese stock index, and XTI USD, and this is the symbol for crude oil. Also NDX, which is the US tech index, and SPX, which is the S&P 500. And then from there, we can also see gold and numerous Forex pairs. So this particular trader is trading Forex, stock indices, and a selection of commodities all in the same account to give him that level of diversification across these different asset classes. And please do feel free to take a look at all of the metrics that are available, and also bear in mind that you can actually link your existing trading account into the Darwinex platform so that you can get metrics like these yourself. Also, if you open up your own Darwinex trading account, you actually get a much wider selection of metrics to analyze your own system. So hopefully you found that useful today. If the next episode where we're going to look at the second technique for diversification is already out, then you'll see that top right now. Please do give me a thumbs up, and now until next time, trade safe.